What if I told you a stock falling 20% doesn't mean your investment has become riskier? Most of you think price goes down, risk goes up. But I look at it differently. For me, the real risk isn't simply that the stock price falls. The real risk is permanent loss of capital. And this one idea can completely change the way you invest. What is risk? Imagine you buy a stock for 1000 rupees and after few months the market becomes fearful. Your stock falls to 700 rupees. You look at your portfolio and think, I have lost 300 rupees. This investment has become more risky. But what if the stock is still worth 1500 rupees? Its profits are growing, debt is under control, customers are loyal, competitive advantage remains strong. The business hasn't deteriorated, only the price has changed. This philosophy will encourage you to distinguish between price risk and business risk. Volatility is not equal to risk. This is one of the most important concepts for long-term investors. Suppose a stock moves from 1000 rupees to 1100. From 1100 it moves to 900. From 900 it moves to again 1200. From 1200 it moves to 800. And from 800 it moves to 1500. The stock is highly volatile. But suppose the underlying business keeps on increasing its earning and intrinsic value. Now consider stock B. Stock B moves from 1000 rupees to 1050 to 1100 to 1150. It's very stable. But underneath, debt is increasing, profits are declining, competitive advantage is disappearing. Which one is actually riskier? Stock B can be far more dangerous despite being less volatile. Two types of risk. First, permanent loss of capital. Could this business permanently destroy your capital? This can happen because of excessive debt, poor management, fraud, declining competitive advantage, technological disruption, bad capital allocation, buying at absurd valuation. This is the risk I care deeply about. Second, opportunity risk. This is the risk you often overlook, paying too much. Even a wonderful business can become a terrible investment if you pay unreasonable price. This is where the margin of safety becomes important. Imagine you estimate a business for 1000 rupees per share. Would you happily pay 1000 rupees? Not necessary. You might want to buy it at 800 rupees or perhaps 700 rupees because your valuation isn't perfect. Your assumptions could be wrong. The economy could change. The company could disappoint. The margin of safety gives you a buffer against being wrong. The less certain you are, the greater the margin of safety you may want. I don't try to eliminate all risk. This is another important lesson. You cannot eliminate the risk completely. Even the best businesses can face recession, regulation, competition, technological changes, management mistake, unexpected events. Instead of trying to predict every possible problem, own businesses that has characteristics that reduces the possibility of permanent capital loss. That's why business quality matters. The circle of competence. One way to reduce risk is simple. Do not invest in businesses you do not understand. If you cannot explain how does the company makes money, why customers buy its products, what its competitive advantage is, what could destroy that advantage, how it generates cash, then you may not understand the investment that well. Your circle of competence doesn't need to be huge, it needs to be clear. Risk doesn't come from not knowing the future. Risk comes from not knowing what you are doing. The stock market will always be volatile. Prices will rise, prices will fall, market will panic, market can become euphoric. But your job as an investor isn't to eliminate volatility, it is to avoid permanent loss of capital. So remember, volatility is a number, risk is permanent loss. The best defense against permanent loss is quality business plus reasonable price plus margin of safety plus patience.